Welcome to the fourth quarterly IFRS update for 2022. I'm Jean-Maré Franklin, and I'm delighted to be co-presenting with my colleagues in Global Corporate Reporting Services, Anu Pandya, Laura Kennedy, and Scott Bandura. Our update covers a number of topical issues, which we have categorized into year-end reminders, IFRS 17, not just for insurers, accounting for rising inflation and interest rates, and accounting for climate-related matters. The first category, year-end updates, focuses on those topics of particular relevance to the upcoming December year-ends. These include an update on OECD global minimum taxes, the latest view on hyperinflationary economies, a reminder of the common cash flow statement pitfalls, a recent IFRS Interpretations Committee agenda decision on lesser forgiveness, and an update on the proposed IFRS 9 amendments relating to electronic cash transfers. As a reminder, you are able to use these timestamps in the description below the video if you want to go straight to one of the topics we're discussing today. Please bear in mind that this content is for general information purposes and is not a substitute for consultation with professional advisors. We've previously discussed the OECD global minimum taxes, often referred to as GLOBE or Pillar 2 taxes in both our second and third quarterly updates. As a high-level reminder, in December 21, the OECD released the Pillar 2 model rules to reform international corporation tax so that large multinationals will be liable to pay a top-up tax for the difference between their GLOBE effective tax rate per jurisdiction and the 15% minimum rate. This effectively establishes a global minimum effective tax rate of 15%. In our third quarterly update, we mentioned the complexity when considering the deferred tax implications of the Pillar 2 tax regime and the ISB staff's intention to bring a paper to the board on this topic. Since then, in November, the ISB discussed a temporary exception to the accounting for deferred taxes that arise for Pillar 2. The exposure draft proposing this will be issued in January 2023 and is also expected to include certain disclosure requirements. There will be a reduced comment period as time is of the essence to clarify the IS-12 interaction with the Pillar 2 rules. We have recently issued an in-brief on this latest development, and you will be able to find a link to this in-brief below the video. For December year ends, provided that legislation has not been enacted by local jurisdictions at year end, there will be no Pillar 2 related recognition or measurement considerations. However, entities might need to provide disclosure of any material expected future impact to the extent that this is reliable and relevant to meet the disclosure requirements of IS1. We have previously issued an in-brief titled Global Implementation of Pillar 2 and the Disclosure Implications, which provides more guidance, and the link is below for ease of reference. In our second quarterly update, we shared that the list of hyperinflationary economies in 2022 expanded to include Turkey and Ethiopia, and that IS-29 became applicable to periods ending on or after the 30th of June 2022 for Turkey and periods ending on or after the 31st of December 2022 for Ethiopia. We also shared an overview of the application of IS-29, which you are still able to watch on demand. There are a number of countries that remain on the watch list. Shortly after the release of our third quarterly update, it seemed that Sri Lanka might have become hyperinflationary based on Sri Lanka's central bank's local data in September. However, following the release of the central bank's data for October, as well as data published by the IMF, we believe that the rise in inflation is expected to tail off in response to the action taken by the government, such as increases in interest rates. Therefore, Based on qualitative and quantitative factors, the expectation is that Sri Lanka will not become hyperinflationary by December 2022 and remains on the watch list for now. The cash flow statement continues to be a common area for errors. Businesses and their transactions have evolved since IAS 7 was first issued in 1992. As a result, preparers and reviewers of a cash flow statement may need to apply judgment where there is limited guidance in IAS 7 to address some of the complexities that arise. In addition, the cash flow statement is usually the last primary financial statement to be prepared, which often introduces a degree of time pressure for both the preparer and the reviewer. These factors contribute to the risk of errors. We want to reiterate the importance of watching out for the common errors seen in cash flow statements. We included a more detailed session on common errors in our Q2 webcast, which you may want to refer to. At a high level, 4 things to be mindful of are: 1. Ensure that the cash flow statement is consistent with the rest of the annual report. 2. Remember to disclose material non-cash transactions. 3 is ensure that the definitions of operating, financing, and investing cash flows, as well as cash and cash equivalents, are applied. And lastly, avoid the inappropriate netting of cash flows.
The next year update we wanted to highlight is the recently issued agenda decision on lessor forgiveness of lease payments. The IFRS Interpretations Committee finalized this agenda decision in October 2022. And this was in response to a submission it received on how a lessor accounts for a particular rent concession in an operating lease. In this rent concession, the only change to the lease contract is the forgiveness of certain lease payments that are due from the lessee. Some of these forgiven lease payments have already been recognized by the lessor as an operating lease receivable, along with the related lease income, whereas the other forgiven lease payments have not been recognized as they relate to future lease payments. Rent forgiveness was prevalent during the COVID-19 pandemic, and lessors that forgave material amounts in prior periods may be impacted by this agenda decision. So what did the agenda decision say about the accounting for this fact pattern? The committee concluded that in reporting periods before the lease payments are forgiven, the lessor must measure expected credit losses on the operating lease receivable on a probability-weighted basis by evaluating a range of possible outcomes. And this must include its expectation of forgiving lease payments that have been recognized as an operating lease receivable. The agenda decision does not provide guidance on the impact of collateral on expectations of a cash shortfall. In line with the requirements in IFRS 9, when measuring ECL, lessors should consider cash flows that are expected from collateral that are not recognized separately. However, this is only to the extent that the lessor expects to reduce a cash shortfall through its realization of the collateral. Once the lease payments are forgiven, the committee concluded that the lessor should apply the derecognition requirements in IFRS 9 to the operating lease receivable and apply the modification requirements in IFRS 16 to future lease payments, including accrued lease payments. In applying the requirements in IFRS 9, the lessor should remeasure the ECL on its operating lease receivable immediately prior to the date the lease payments are forgiven, with any changes being recognized in profit or loss. Once the lease payments are forgiven, the lessor should derecognize the operating lease receivable, including any associated ECL allowance. So what are the key reminders to take away from this update? The key takeaway is that if lessors had previously applied IFRS 16 as an accounting policy choice to forgiveness of amounts contractually due for past rent, they will be impacted by this agenda decision. A key point highlighted by the agenda decision is that lessors must apply IFRS 9 to the forgiveness of lease payments, which are currently due and payable for past rent. The forgiveness of lease payments relating to future periods, including accrued lease payments that do not meet the definition of an operating lease receivable, is not in the scope of IFRS 9. Our final reminder on this issue is that the agenda decision must be applied retrospectively, which may result in changes to comparative figures. The agenda decision's effective date follows the ISB 2 process, which provides entities with sufficient time to implement any changes in response to the agenda decision. If you'd like some further details on this issue, please refer to our in-brief on this matter. Our last hearing update for this webcast is the ISB standard setting project on electronic cash transfers. In our last webcast, we discussed the background behind the ISB's decision to explore narrow scope standard setting in this area. And today we're going to share with you the most recent developments on what the standard setting will look like and the timeline. In November 2022, the ISB voted to propose amendments to IFRS 9 to include a clarification that an entity applies settlement date accounting when recognizing and derecognizing financial assets and financial liabilities. IFRS 9 currently only includes an exception to settlement date accounting for a regular way purchase or sale of financial assets. When applying this exception, financial assets should be recognized or derecognized using either trade date accounting or settlement date accounting, depending on the entity's elected accounting policy choice. In addition to this existing regular way exception, the ISB is proposing to amend IFRS 9 to include an additional exception, an accounting policy choice that would allow entities to derecognize a financial liability before the settlement date. To apply this accounting policy choice, certain criteria would need to be met. The paying entity must have no ability to withdraw, stop, or cancel an electronic payment instruction. The entity must have lost the practical ability to access the cash as a result of the electronic payment instruction, and the settlement risk associated with the electronic payment instruction must be insignificant. The ISB decided that the scope of this new proposed accounting policy choice will remain limited to financial liabilities settled using electronic cash payment systems and will not be extended to all payment methods, such as check payments. The accounting policy choice is also not applicable to the settlement of financial assets, such as trade receivables, that are settled through electronic cash transfers. Based on the ISB's discussions, we expect that an exposure draft will be published in the second quarter of 2023 with a comment period of 120 days. Any changes to accounting practices required or permitted as a result of these amendments would need to be made by the effective date that will be specified when the narrow amendment is finalized, subject to any endorsement considerations. Considering these timelines, you may be wondering why we are highlighting this as a relevant update in this webcast. Because of the pervasiveness of this issue and current existing practices, we believe that entities with December 2022 year ends should disclose their current accounting policies, if significant. We would typically not expect entities to provide quantitative disclosures if the entity does not have reasonable and supportable information readily available. However, an entity should consider if qualitative disclosures are required to enable users to understand the impact of these transactions. If you'd like further details on this matter, please refer to our in-brief on this topic.
Our next topic is IFRS 17, the new accounting standard for insurance contracts, which comes into effect very soon on the 1st of January 2023. And this accounting standard represents a huge change for the insurance industry, and they've been preparing for it for the past 5 years. But it's not just the insurance industry that's going to be affected. More contracts than you might expect could actually be insurance contracts, even if they're not labeled as an insurance contract. They're not sold by an insurer, and their primary purpose isn't necessarily to provide insurance. So interestingly enough, the definition in IFRS 17 of an insurance contract hasn't really changed compared to the current accounting standard. The difference now is it's become significantly more important to identify insurance contracts, because unlike the previous accounting standard, the new one has specific and detailed measurement requirements. So it's now important that all entities have a good understanding of the scope of IFRS 17. And to help out with this, we've recently updated our guidance on exactly that, which is an in-depth that's available on Viewpoint. And today we're going to touch on some of the basics. What is an insurance contract? What contracts are explicitly excluded from the scope of IFRS 17? Cases where entities are given a choice between using IFRS 17 or another standard, and the requirements for separating out some non-insurance components. So before we get into what an insurance contract is, we need to first know that insurance contracts are in the scope of 17 only if the entity is the issuer. So for the holder that purchases the contract, it doesn't usually get captured by IFRS 17. The only case that an insurance contract is in the scope of IFRS 17 for the holder is for reinsurance contracts. But it's less likely that you're going to have one of those without knowing about it. So an insurance contract is defined in IFRS 17, and it's defined as a contract under which one party, so that's the issuer, accepts significant insurance risk from another party, so that's the policyholder. And it does that by agreeing to compensate the policyholder if a specified uncertain future event adversely affects the policyholder. So if we break down that definition, the key components there are 1, significant insurance risk, 2, adverse effect on the policyholder, and 3, uncertain future event. So let's unpack those one by one. Starting with an uncertain future event, which is described in IFRS 17 as the insured event. Uncertainty is the essence of an insurance contract. And so it's the first thing to look out for when you're considering whether a contract might provide insurance. That means an insured event must be an event that has uncertainty around one or more of 3 things. Whether the event will happen at all, so for example, an accident, when the event will occur, so for example, death, and lastly, uncertainty over how much something will cost, so for example, rebuilding a home after an earthquake. The next key element here is adverse effect on the policyholder, and this is also known as having an insurable interest. And this notion ensures that a number of contracts that have an uncertain future event, but that are not traditional insurance contracts, won't get captured by IFRS 17. So as an example, this means that IFRS 17 doesn't include in its scope contracts such as gambling contracts and weather derivatives. Because while there's an uncertain future event in those contracts, that event wouldn't necessarily have an adverse effect on the party that's taken out the contract. Moving on to item 3, the definition of an insurance contract revolves around the notion of significant insurance risk. An insurance risk is any risk other than financial risk that's transferred from the policyholder to the issuer of the contract. And so that excludes financial risks such as changes in specified interest rates, financial instruments, or market indices. If there is insurance risk in the contract, we next need to determine if that risk is significant, and that requires judgment. While IFRS 17 doesn't provide any specific thresholds, it does provide guidance to help entities in making that judgment. It says that insurance risk is significant only if the compensation for the insured event would be significant in any single scenario. So that's considering essentially what is the worst case scenario. It goes on then to explain that even if the compensation in the worst case scenario could be significant, insurance risk isn't significant if there's no possibility that the issuer of the contract is going to make a loss when it looks at the future cash flows on a present value basis. So let's look at a simple example and see how the definition applies. For a pre-agreed price, entity A, an IT service provider, agrees to repair, or if it's necessary, to replace customer B's IT equipment at any time the equipment malfunctions within the next 5 years. So question 1, is there an uncertain future event? Yes. So the event here is whether and when the IT equipment will malfunction. On top of that, depending on the specific facts and circumstances, it might also be uncertain how much it's going to cost to pay for any repairs or replacement equipment. Moving on to question 2. Does the uncertain future event have an adverse effect on the policyholder? Yes. Customer B uses IT equipment, and without this contract, it would need to pay to repair or replace that equipment, or it would need to go without that equipment altogether, which could have a detrimental effect on its business. So then we get to question 3. Does entity A accept significant insurance risk? And so as we've just discussed, there is judgment in this question depending on the specific terms of the agreement. But based on what we know here, the answer is likely to be yes. The risk of malfunction has been transferred to entity A, and in a worst case scenario, it could be that the equipment could malfunction a number of times and that there could be sharp increases in the cost to replace or repair the equipment, and those costs might be outside of entity A's control. So this contract is likely to meet the definition of an insurance contract in IFRS 17, but that isn't where we end our assessment. Even if a contract is an insurance contract, it might not be in the scope of IFRS 17. IFRS 17 provides some explicit scope exclusions, as well as some scope choices. And then on top of that, for contracts that are in the scope of IFRS 17, there are requirements for separating some types of non-insurance components to be accounted for under different IFRS standards. And so we're going to go through each of these 3 areas one by one. Starting with scope exclusions. IFRS 17 provides 8 different scope exclusions, generally aimed at excluding some common arrangements that do not typically have as their primary purpose insurance coverage, and that are not typically labelled or considered as insurance contracts, but that could meet the definition if they transfer significant insurance risk. Here we have 3 of those exclusions as examples. One is warranties, and those are those that are provided by the manufacturer, the dealer, or the retailer related to the sale of their goods or services to the customer. So, for example, that could be warranties provided over white goods or electronic devices, and those transactions are in the scope of IFRS 15. Another scope exception is an employer's assets and liabilities that come from employee benefit plans, and also retirement benefit obligations, those that are reported by defined benefit retirement plans. And all of those are covered by IAS 19, IFRS 2, or IAS 26. The third scope exception here is residual value guarantees, and that is both those that are provided by the manufacturer, dealer, or retailer. So similar to the first, those are in the scope of IFRS 15, and also those residual value guarantees that might be embedded in a lease, which is in the scope of IFRS 16. As well as scope exclusions, IFRS 17 provides some choices for applying IFRS 17 or another standard to some types of contracts. The first that we have here is fixed fee service contracts, such as vehicle breakdown cover or boiler cover that might offer repairs, maintenance, and perhaps parts replacements to a customer for a fixed price. If these types of contracts transfer significant insurance risk, they will be in the scope of IFRS 17 unless they meet 3 specified criteria. And so those criteria are that the pricing of the contract doesn't reflect a specific assessment of that individual policyholder's risks, that the entity is compensating the customer not by making cash payments, but instead by providing services, and also that the insurance risk that is transferred in the contract arises primarily not because of the uncertainty over the cost of providing the services, but instead from uncertainty over how much the customer will use the service. The next scope choice we have here is loans that include insurance over repayment. So as an example, this could include a student loan that limits repayment based on how much the student earns over a specified period after university. And it also includes lifetime mortgages, which are also known as equity release mortgages. And these are contracts under which an entity provides a customer with a retirement loan, and the repayment of that loan is limited to a specified portion of the value of a collateral property at the time that the customer dies. And for these types of contracts, an entity can choose to instead apply IFRS 9, so long as the compensation is limited to the amount that the customer would otherwise be required to pay under that contract. So to finish off our IFRS 17 update today, the last thing I wanted to touch on is separating non-insurance components. This area of the requirements becomes relevant for any contract that has met the definition of an insurance contract and that isn't scoped out by one of our scope exemptions or scope choices. So IFRS 17 provides specific requirements on separating some components out to IFRS 9 and other components out to IFRS 15. Any non-insurance component that isn't captured by those specific requirements are not permitted to be separated, and instead those stay as part of the contract as measured under IFRS 17. So there are two types of components that are separated into IFRS 9. The first is some embedded derivatives, and an entity uses the requirements in IFRS 9 to determine whether there is an embedded derivative that should be separated. And the second one there is distinct investment components, which are amounts that are repayable to the customer in any circumstance, regardless of whether a particular event occurs or not. So that's kind of like deposits. But not all investment components are distinct from the insurance element of the contract, and IFRS 17 provides criteria for making that assessment. Any investment components that are not distinct, again, stay in the measurement of the insurance contract. Moving on to IFRS 15. If a contract includes promises to transfer goods or non-insurance services, as well as an insurance element, and those goods and services are distinct from the insurance element, that component is separated and accounted for applying IFRS 15. Again, not all goods and non-insurance services will be distinct from the insurance element, and IFRS 17 has requirements for identifying whether they are or not. So some examples of goods or services that might be included in a contract with insurance and that might be separable would include a gym membership or a smartwatch that might be provided alongside health insurance. And also it could include hotel management services that sometimes are included in the same contract as a guarantee, such as an EBITDA guarantee that might transfer significant insurance risk. So that covers everything we had on IFRS 17 for today. If you're looking for more guidance on IFRS 17 for non-insurance entities, please do check out our newly updated in-depth available on Viewpoint.
Rising inflation and interest rates, as well as other market changes that can accompany rising rates, may introduce new challenges when preparing financial statements and increase the relevance of some disclosures. Challenges that an entity faces as a result of rising inflation and interest rates can have a wide-reaching effect on the financial statements and need to be considered when applying many of the IFRS requirements. We've published an in-depth on navigating IFRS accounting standards in periods of rising inflation and interest rates that walks through each key area of the IFRS requirements that could be most impacted by these economic factors. In the next few slides, we'll reflect on a few of these key areas, including presentation of financial statements, impairment of non-financial assets, employee benefits, revenue, and financial instruments. In recent reports from regulators such as ESMA, the European regulator, and the FRC, the regulator in the UK, similar considerations to the ones that we will be discussing today have been highlighted. It is important for entities to keep in mind the views of any relevant regulators when preparing their financial statements. Let's touch on 4 areas relating to IS1 which may be impacted by rising inflation and interest rates. Firstly, disclosing material information. For December 2022 year ends, the disclosure requirements in IS1, including the requirement for disclosure of material other explanatory information, will have to be carefully assessed against the backdrop of rising inflation and interest rates. It's important to be mindful that some disclosures may now become material, where perhaps previously they were assessed not to be. For example, where the replacement costs of key operational assets are expected to be significantly higher than their previous purchase cost or that previously budgeted as a result of inflation, an entity may determine that this is material other explanatory information that should be disclosed. Secondly, current and non-current classification. If an entity's financial position has deteriorated as a result of rising inflation and interest rates, it may no longer be able to meet covenants and service its debt. A breach of covenants typically requires a reclassification of a debt liability from non-current to current in the absence of a formal waiver as at the reporting date. Thirdly, line item disaggregation. An entity may need to consider whether information that was previously aggregated within a line item now needs to be disaggregated, as they may have become material given the impact of rising inflation or interest rates. And lastly, going concern. Rising inflation and interest rates may have a significant negative impact on factors that directly impact the going concern assessment. Examples include an adverse impact on customer behavior and sales volumes, narrowing of operating margins because an entity may not be able to pass on increased costs such as energy prices onto customers, a significant rise in the replacement cost of key operational assets, and a decrease in funding alternatives. The impact of rising inflation and interest rates is far-reaching when assessing the impairment of non-financial assets. Our in-depth describes the impact on impairment indicators, the value in use calculation, the determination of fair value less cost of disposal, as well as disclosures. We consider this well worth a read. In today's update, we want to focus on the terminal value, which is often a significant portion of an asset's value in use. It is typical for management to produce budgets and forecasts not exceeding a 5-year period. IAS 36 also tells us that this is the right thing to do unless management can demonstrate its ability to forecast cash flows accurately for longer periods. In a value in use calculation, a terminal value is determined for the terminal period, which is the period beyond management's budget or forecast. This terminal value relies on the extrapolation of cash flows in the final year of management's forecast. Now, where cash flows are nominal, and that means they include the impact of inflation, the growth assumptions used to extrapolate the cash flows are often determined with reference to available inflationary data. Where the rate of inflation is expected to change significantly over the terminal period, whether that be increasing or decreasing, the impact may need to be considered in the extrapolation. One way of doing this would be to extrapolate within defined periods which reflect the changing inflationary data associated with each of these periods. This relies on the fundamental principle of consistency between the discount rate and the cash flows. The discount rate, which is often a WACC, incorporates all relevant market information, and the aim is to ensure that there's consistency with the assumptions built into the expected cash flows. Let's use an example to illustrate this. Assume management produced a budget for the next 5 years with a net cash inflow of 20,000 a year in year 5. Beyond year 5, the expected rate of inflation based on market expectations for the medium term is 7% in year 6, and this will taper down smoothly to a long-term rate of 4% by year 9. For simplicity, we assume the entity has the ability to fully pass on inflationary increases onto its customers. Using the 7% medium-term inflation rate to extrapolate the cash flows into perpetuity will overstate the terminal value, as this does not represent a maintainable steady state of growth. IAS 36 tells us to use steady state assumptions when calculating the terminal value, and therefore management may use the long-term rate of 4% to extrapolate the cash flows. However, in this example, where there is a significant difference between the medium-term inflation rate and the long-term rate, management may achieve a better expected cash flow forecast by extrapolating the budget to reflect both the medium-term and the long-term inflation expectations. We can see this on the slide opposite, where the medium-term inflation rates are reflected in year 6 to 8. Year 6 extrapolates the year 5 net inflow of 20,000 using 7%. Year 7 extrapolates the net inflow in year 6 by 6%, and so on until year 9. In year 9 and into perpetuity, the extrapolation is done using the long-term inflation expectation of 4%. Rising inflation and interest rates may have a significant impact on employee benefits. In our in-depth, we detail a few examples which consider: 1, the impact on defined benefit plans resulting from changes in discount rates, as well as other financial estimates used in the measurement of defined benefit obligations, for example, future increases in salaries and medical costs. 2, possible new constructive obligations. If an entity starts increasing salaries in response to rising inflation, even though it has no legal obligation to do so. And lastly, the relevant accounting considerations if employers offer loans to employees at a favorable interest rate relative to the increasing interest rates. Rising inflation and interest rates may also impact revenue from contracts with customers. Some examples, most of which are covered in our in-depth, include scoping, significant financing components, pricing changes, costs incurred to fulfill a contract, onerous contracts, and disclosure. Now let's look at each of these in turn. Scoping. A significant deterioration in a customer's financial position that affects their ability to make payments may result in the contract being scoped out of IFRS 15. Significant financing components. Here, rising inflation increases the financial impact of time value of money, and this could result in a greater incidence of financing components being considered as significant. Pricing changes. So rising inflation may result in pricing changes, either as a result of a modification to an existing contract or a change in the variable consideration to which an entity expects to be entitled to under the existing contract. It's important to distinguish between a contract modification and a change in the transaction price associated with the change in the expected variable consideration, as the accounting consequences may differ. On this point, ESMA emphasized the importance of relevant disclosure. Costs to fulfill a contract. Now, this point has been raised by ESMA. They recommend caution to be applied when recognizing an asset for costs incurred to fulfill a contract in a period of high inflation, as the additional costs may not be recovered due to the rising prices of materials, energy costs, and salary increases. Now, onerous contracts. In the current economic environment of rising inflation, more contracts with customers may become onerous. For example, if an entity has a cost base which is subject to significant inflationary increases, a contract with a customer may become onerous if the consideration the entity expects to be entitled to does not allow for inflationary or related adjustments. And then disclosure. IFRS 15 requires an entity to disclose information that allows users to understand the nature, the amount, timing, and uncertainty of cash flows arising from revenue. This might require, for example, information about how an entity has applied its policies, taking into account the uncertainty that arises from the economic climate if it affects the significant judgments applied, such as whether a customer is able to pay, and the significant estimates made, such as those relating to variable consideration.
When it comes to accounting for financial instruments in times of rising inflation and interest rates, there are a multitude of considerations to keep in mind. There are a couple of key points we wanted to highlight in this webcast, but please do refer to our in-depth for further considerations. A frequently asked question is whether an entity can change its measurement model for financial assets due to rising inflation and interest rates. Under IFRS 9, financial assets that are debt instruments can either be classified and measured at amortized cost, at fair value through other comprehensive income, or at fair value through profit or loss. The classification depends on the entity's business model for managing the financial assets and the asset's contractual cash flow characteristics. An entity might change its intention for financial assets as a result of changes in the economic climate. For example, an entity may hold assets that it previously intended to either hold to maturity or sell, and so is currently measuring the assets at fair value through other comprehensive income. Due to rising inflation and interest rates, the entity may change its intention and no longer intend to sell the assets. In this example, the question we often get asked is, can the entity change its measurement model to instead measure the assets at amortized cost? Generally, the answer is no. IFRS 9 permits reclassification to a different measurement category only if an entity changes its business model for managing financial assets. Changes in intention related to particular financial assets are not changes in business model, even if they arise because of significant changes in market conditions. It is unlikely that the reclassification criteria will be met even in a rising inflation and interest rate environment, as demonstrating a change in business model is a high hurdle under IFRS 9. However, the entity will have to evaluate purchases of new financial assets to determine if they should be recorded in a different portfolio, with the old portfolio being in rundown mode. If we turn our attention to measuring expected credit losses in times of rising inflation and interest rates, this may be another challenging area for both corporate entities and financial institutions. Many entities use a provision matrix to estimate ECL for short-term trade receivables and contract assets. Entities that use a provision matrix may need to apply additional stratification to reflect the impact of rising inflation and interest rates. This is because different industries may be impacted differently by inflation and interest rates. Historical loss rates applied in a provision matrix may need to be adjusted more significantly for changes in expectations than in the past. This will especially be the case if historical data used to derive the loss rates was gathered in periods of low inflation. If we shift focus away from use of a simplified model to measure ECL and consider the general model under IFRS 9, we know that the general model requires that financial assets be classified as either stage 1, stage 2, or stage 3. In times of rising inflation and interest rates, assets that might otherwise be considered stage 1 may need to be moved to stage 2 or even stage 3 due to changes in credit quality since initial recognition of the asset. Transfers made as a result of the increasing credit risk mean that an entity will need to measure full lifetime expected credit losses, which may be significantly higher than a 12-month ECL measured for stage 1 assets. Apart from the impact of staging, there may be changes in the estimation of ECL itself under the general model. This is because forecasting future conditions is more challenging in an environment of rising inflation and interest rates. Entities will need to rely less on or make adjustments to historical information to reflect estimates of future conditions. Moving away from ECL, there are also other areas of financial instrument accounting that may be impacted in times of rising inflation and interest. For example, there are several hedge accounting considerations to keep in mind, and you can find these considerations in our index. The one consideration we specifically wanted to highlight in this webcast relates to hedging reserves. Under both the I-39 and IFRS 9 hedge accounting models, entities are required to assess the recoverability of their hedging reserves. IFRS does not provide specific guidance on how the recoverability test should be applied, so entities should follow their existing accounting policies for the assessment of recoverability of these amounts. Where debit balances accumulated in other comprehensive income relating to cash flow hedges are significant, an entity should consider whether disclosure about the accounting policy and a significant judgment in the application of that policy is required. Another area to consider is the impact of inflationary clauses and interest rate caps and floors in contracts. In periods of rising inflation and interest rates, an increasing number of contracts may include such features, which should be carefully analyzed. For any host contract that is not a financial asset, so for example, a financial liability, an entity needs to assess whether such a feature is an embedded derivative that needs to be separated from the host contract and measured at fair value to profit or loss. An entity makes this assessment when it first becomes a party to the contract and revises the assessment only if there is a significant change in contractual terms. A change in market conditions does not give rise to a reassessment. IFRS 9 simplifies the accounting for embedded derivative in host contracts that are financial assets by removing the requirement to consider whether the embedded derivatives should be separated. The classification approach in IFRS 9 applies to all financial assets, including those with embedded derivatives. An entity should apply the business model assessment and SPPI criterion to the entire contract to determine its measurement category, and this includes any pricing features in the contract. Finally, financial instrument disclosures required by IFRS 7 should be front of mind, especially with this being a regulatory focus area. In a period of rising inflation and interest rates, and the resulting volatility in FX rates and commodity prices, the importance of transparent financial instrument disclosures is heightened. Let's start with sensitivity disclosures required by IFRS 7. It will be necessary to consider if sensitivity disclosures need to be updated. For example, if the magnitude of a reasonably possible change in interest rates is different from previous periods, a different reasonably possible threshold used for sensitivity is likely required compared to prior years. Similarly, foreign currency exchange risk, commodity price risk, and other market risks might require updated thresholds. In addition, changes in the economic climate can lead to the fair value of a financial instrument differing significantly from the amortized cost carrying amount. Some financial instruments that previously qualified for the exemption from disclosing fair value information because of the fair value being so close to carrying amount may no longer qualify for that exemption. Liquidity risk may also be heightened for entities exposed to interest rates. This could be both in cases where the entity is exposed to cash flow interest rate risk on floating rate instruments or fair value interest rate risk on fixed rate obligations that are nearing renewal. Additional discussion of exposure to liquidity risk may be required. And as a reminder, the liquidity table disclosing interest payments should also be updated for floating rate instruments. We are frequently asked whether sensitivity to inflation should be disclosed under IFRS 7. An entity may need to provide specific disclosures relating to inflation risk if this information is not already captured in other market risk disclosures. For example, if an entity has an inflation-linked financial instrument, a sensitivity analysis on income or OCI should be shown for reasonably possible changes in inflation rates. In a volatile economic climate, it is likely that entities will encounter increasing margin calls on derivatives, requiring the posting of collateral. If collateral calls pose a significant liquidity risk, entities need to provide qualitative and quantitative disclosures of their collateral arrangements to explain how this liquidity risk is managed. The carrying amount of financial assets pledged as collateral for liabilities or contingent liabilities should also be disclosed together with the terms and conditions relating to its pledge.
Hello. As we've discussed before, the impact of climate change is a high-profile issue, and both investors and regulators are very focused on it. Today, we'll hone in on three specific areas relating to the accounting for climate-related matters. Firstly, impairment of non-financial assets. Secondly, provisions, contingent liabilities, and contingent assets. And thirdly, power purchase agreements. Okay, turning to impairment, we'll cover three main topics: impairment indicators, assumptions reflecting climate-related matters, and disclosure considerations. Looking at impairment indicators, significant changes in the market, such as a decrease in the demand for goods and services that contribute to greenhouse gases, or in the regulatory environment in which an asset operates, such as additional carbon taxes, or even changes to the entity's plans for an asset or cash-generating unit as a result of climate commitments, could all be examples of external or internal indicators of impairment linked to climate-related risks. Also, entities should consider that engaging in activities that are seen as potentially damaging to the environment could result in reputational damage, loss of customers, and this in turn could impact the value of brands, trademarks, and other intangibles. Voluntary environmental commitments that the company has made may also need to be taken into account in assessing indicators. For example, a commitment to discontinue a product line or decarbonize operations. When we look at the recoverable amount of assets or cash-generating units, let's talk first about the value in use model, or VIU. In a VIU model, future cash flows are estimated for the asset in its current condition. Over time, the impact of climate change will likely result in an adjustment to the forecast revenue expected to be generated from an asset or the cost relating to those assets. The timing of the changes in these cash flows will differ between industries and countries. So if we look at revenue to start out, sales forecasts could decrease if consumer behavior changes. It could increase if opportunities can be taken to shift to greener products. And it could also change based on whether increased cost as a result of climate-related matters are able to be passed on to customers. So turning more to the cost side of the equation, increased costs could result, for example, if green targets exist that are expected to require an entity to source greener, perhaps more expensive input factors due to additional carbon taxes or carbon offset certificates that are expected to be purchased. For example, if green targets are self-imposed or arise via legislation, due to physical risks in the location of operations, for example, if it's in a flood area, and the related impact even on insurance premiums that might be charged for those assets, and turning more to the actual physical risks, looking at additional maintenance and repair expenditures that might be required depending on the nature of the assets, for example, again, if they're in a flood zone, for instance. While all these are potential changes that need to be considered, you have to remember as well that for purposes of preparing a VIU assessment, not all potential improvements are allowed to be included. The VIU method has strict limits on when improvements relating to the benefits of restructuring or enhanced performance can be taken into account. These benefits can only be reflected in a VIU calculation once an entity is committed to restructuring, and for enhancements to assets, the benefits can only be taken into account once an entity has started to incur the related expenditures. And just in general, for recoverable amount, remember that the higher a VIU, or fair value less cost of disposal, needs to be used. Fair value calculations have slightly less restrictions than value in use because they're ultimately based on market participant assumptions using factors that such market participants would consider in relation to the assets. Okay, turning to assumptions and sensitivity analysis. Remember that reporting entities should provide clear descriptions of any significant climate-related assumptions and disclose the impact of sensitivity to those assumptions. So for example, a company planning to significantly change the inputs used in a production process might discuss the impact of these assumptions on their impairment analysis, where commodity prices are considered key inputs, such as oil and gas or electricity prices, quantifying those inputs, explaining how they've been derived, and any associated judgments should be considered. When we look at disclosures as well, where material, reporting entities should provide comprehensive disclosures on whether and how climate-related matters are factored into the determination of cash flows, the discount rate used, such as the WACC, or weighted average cost of capital, the growth rate, and the terminal value of assets, or a CGU. An entity might also disclose whether climate-related expenditures are necessary to meet the entity's decarbonization strategy, including whether they plan to use carbon offsets or carbon credits, and how those were incorporated, and whether different climate-related scenarios were taken into account in coming up with cash flow estimates. Turning now to provisions, it will be important for entities to be attentive to the requirements in IAS 37, provisions, contingent liabilities, and contingent assets, and assess whether climate commitments or environmental damage gives rise to legal or constructive obligations. In terms of environmental damage, it can occur in a number of ways, including contamination of land, pollution of rivers and waterways, emissions of harmful gases into the atmosphere, and excavation. Some aspects of environmental damage are controlled by legislation, whereas others are not. An entity's response to environmental damage may create constraints in the way that the entity can operate. These constraints can arise from legislation, or they may be constructive. For example, where an entity makes a statement that it will rectify damage or creates an obligation through an established practice of rectifying past damage. Some questions that need to be considered in assessing whether climate-related commitments are legal or constructive obligations include whether there's an outflow of economic resources. Constraints don't necessarily give rise to liabilities because operating within a constraint does not necessarily require an outflow of economic resources. For example, to comply with environmental regulations, an entity may need to purchase equipment, resulting in the exchange of one resources, for example, cash, for another resource, being the asset that's recognized as PP&E, for example. In such a situation, compliance does not require a net outflow of resources. However, some constraints can give rise to liabilities where compliance or non-compliance will result in an outflow, such as environmental remediation required in order to comply with legislation, or a payment of a fine for non-compliance. Secondly, one can ask, is there a past event that creates a present obligation? Even if the constraint results in an outflow of economic resources from the entity, that alone is not sufficient to create a liability that is recognized under IAS 37. The constraint must exist and the entity must have conducted the activity, so a past event must occur that creates a present obligation for the outflow. Some obligating events can occur over a period of time, for example, as a mine or oil and gas field is developed, and some can occur at a point in time. Also, if legislation is involved, one needs to consider whether the legislation is substantively enacted. For recognition of obligations arising from new legislation, it's important to remember that the requirement for a provision would generally be only when the legislation is substantively enacted. In many cases, this will be when a law is actually passed by a jurisdictional government, becomes legislation, and requires action on the part of the entity. However, an entity would need to understand the meaning of substantively enacted in the particular jurisdictions in which it operates. So, what are the accounting implications of net zero commitments? Well, let's look at a practical example. So say during 2021, the CEO of Entity A makes a public statement that Entity A will, on a global basis, conduct its operations on a net zero basis from the 1st of January 2030. And from 2021 onwards, it will disclose its commitment to be net zero by the beginning of 2030 on its website and in its annual report. Before 2030, the question is, should Entity A recognize a provision for its net zero commitment? In this case, the answer is no. A constructive obligation could exist from the sufficiently specific public statement and disclosures, which could create a valid expectation by other parties that Entity A will in fact be net zero by 2030. However, before 2030, there is no present obligation because the past event that would trigger the constructive obligation is Entity A not conducting its operations from the 1st of January 2030 on a net zero basis. Entities should carefully consider, however, the net zero commitments made and the scope of the standards that they fall into. In this case, there was a general commitment made by the entity such that the provision fell within the scope of IAS 37. There could be other situations where there are promises or performance obligations to customers, and these might be considered under other standards such as standards relating to revenue recognition. Turning now to power purchase agreements, there's a broad spectrum of entities, including retailers, manufacturers, oil and gas companies, etc., that are becoming involved in power purchase agreements or PPAs in order to move towards green or renewable purchases of electricity and earn green certificates. There are two categories of sustainable power purchase agreements: physical agreements that require physical delivery of energy, and agreements without physical delivery called virtual PPAs, financial PPAs, or sometimes contracts for differences. These contracts are sometimes intended to support that the entities are actually or in substance using renewable electricity. For example, some entities enter into virtual power purchase agreements to support achieving their objectives of reducing their carbon footprint relating to electricity input costs. The accounting for PPAs can be complex, and entities should focus on clear and transparent disclosure of the financial impacts and the accounting treatment actually applied to them. This would include such considerations as whether the agreements give rise to any conditions that require an entity to consolidate another entity under IFRS 10, account for the contracts under IFRS 16 as leases or as financial instruments under IFRS 9, or whether they're accounted for as executory contracts, and if so, whether there are any separable embedded derivatives. Entities that physically purchase RECs or renewable energy certificates would often account for them as intangible assets under IAS 38. However, where the RECs are held for resale or consumed in the process of production of inventories, for example, if they're an input cost in the manufacturing of a product, they might meet the definition of inventory under IAS 2. RECs accounted for under either IAS 2 or IAS 38 will be recorded initially at cost on initial recognition. In a physical PPA, the purchase price being paid will need to be allocated between the electricity and the RECs. In a VPPA, where the host contract for RECs is accounted for as own use, the initial cost of the RECs will be determined based on the host contract defined in separating the embedded derivative. When the RECs are used by an entity, for example, canceled, they're derecognized and recognized as a cost of purchased electricity or another appropriate line item, depending on the policies adopted for the entity's income statement presentation in accordance with IAS 1. As mentioned, these arrangements can be quite complex and may have significant financial reporting implications, even though on initial recognition or signing of the contract, there may not be a significant upfront payment. Therefore, entities should carefully consider whether they have adequate controls to identify such arrangements and that they've been appropriately analyzed from an accounting perspective. Our in-depth on green or renewable PPAs from the buyer's perspective goes through a number of relevant considerations and examples for such arrangements.
We covered a lot today, and we hope you found this update helpful. There's a lot of additional information on these topics we covered on Viewpoint. Thank you for listening.